Hi everyone, it's David from Aventine here with another quarterly presentation based on our outlook. This installment is titled The Case for Cuts in Canada, primarily due to the fact that we think the Bank of Canada will be cutting rates at its June meeting. We know that central banks have a dual mandate to manage price stability and employment, and due to the rate-sensitive nature of the Canadian economy, the Bank of Canada risks losing control if rates stay this restrictive. First, however, let's look at asset class performance year to date. If we move from left to right on the chart, we can see that small caps are still suffering while large caps continue to lead the market higher. In terms of sector performance, it's noticeable that the information technology and communication services sector, which together make up the NASDAQ, are still performing well. Obviously, the safety or bond-like sectors, such as healthcare, are lagging, and real estate is noticeably in negative territory as rate expectations got repriced higher over the quarter. Japan leads the developed markets as they maintain zero interest rate policy and inflation is only increasing nominally. The dispersion in emerging markets is noticeable, with Taiwan performing well as they capitalize on the boom in the semiconductor manufacturing industry. Brazil was noticeably weak, however. This has to do with the government limiting the dividend payment of state-owned company Petrobras, leading to people being concerned about more market intervention from the government. Finally, we can see the impact of higher interest rate expectations on the bond market, with only the high-yield segment eking out a positive return. Okay, well let's start by looking at the central bank's favorite inflation metric, core inflation, which in Canada appears to already be at the 2% target level. As you can see from the chart, core inflation readings in the US are nearly 2 times that. So while rates in the US are expected to be higher for longer, we think Canadian rates will be higher for shorter. As we can see, non-core inflation readings are higher, meaning that a large amount of the inflation in Canada is coming from gasoline and housing. However, even with these included, the level of price growth is still under 3%. Here we can also see that CPI in Canada has retraced back to the levels of last summer, while in the US it is ticking higher, and the gap between the figures is widening. Perhaps the most important difference between the US and Canada, and one of the most important indicators when considering rate cuts, is employment. Here we can see that the domestic unemployment rate in Canada, and the slope of this chart, is worrying. The unemployment rate reached 6.1% at its latest reading, compared with the 3.8% reading in the US. Related to this, wage growth in Canada looks to have stabilized at pre-pandemic levels, when rates were obviously much lower. As we know, through immigration, Canada has seen its population grow at a pace not experienced since the 1950s. This dramatically increases the labor supply, which helps keep wage growth down. Economic conditions in Canada remain relatively soft, with GDP growth running under 1% on a year-on-year basis through Q4 of last year. In the US, by contrast, GDP growth regularly exceeds 3%. One of the biggest fears held by many is that easing policy would result in the housing market bubble further inflating. However, the current level of policy has already started to create some pressure on housing prices. Prices of new homes in Canada recently put in their first negative monthly print, other than in the Great Financial Crisis, in nearly 30 years. This contrasts with the US, which is still seeing new house price inflation at much higher levels. It shouldn't be surprising that high interest rates bite harder in Canada. Canadians not only have higher debt loads than Americans, but that debt also renews more regularly. For example, mortgage terms in Canada generally do not exceed 5 years, while in the US, it's not uncommon to find 30-year mortgages. More than 15% of disposable income goes towards servicing debt in Canada, while in the US, the debt service ratio is less than 10%. Part of the difference between the Canadian and US economy can be explained by consumption. The Canadian household savings rate doubled from about 3% prior to the pandemic to 6.2% at the end of 2023, while at the same time we observed a drop in the savings rate in the US. While the consumption of services has grown at roughly a similar pace in both countries over the last 4 years, outlays on goods have grown 5 times slower in Canada compared to the US. This is most pronounced in the highly rate-sensitive durable goods sector, which include autos and appliances. As a result of all this data, conditions are aligning for the Bank of Canada to start to ease, just at a time when those expectations are getting priced out of the US, as we can see from the chart. The expectation for the Federal Reserve to cut in June is approaching 0%, and the likelihood of a December cut is also shrinking. With core inflation at 2%, growth at 1%, unemployment rising at 1% over the last year, and wage growth near pre-COVID levels, the Bank of Canada should cut in June. Finally, here we show that there is precedent for the Bank of Canada to have a vastly different interest rate policy than the Federal Reserve at certain times. Over the last 30 years, policy has been within 50 basis points of one another about half the time. However, when the Fed is above 3%, then the Bank of Canada has been 75 basis points lower about half the time. Now let's touch on interest rates in the US for a moment. While inflation is the primary concern related to interest rates, there is a growing thought that the Fed may lose control of interest rates based on the creditworthiness and supply-demand dynamics of the Treasury market. Consider this. Only 73% of federal spending in the US is covered by tax receipts. This means that more and more debt will be required without significant austerity measures. Since we are in an election year, a reduction in spending seems very unlikely. We are on the cusp of major new Treasury supply as well. Some figures suggest that Treasury issuance in 2024 could nearly double from last year to nearly $2 trillion. And how about demand? We must ask who's buying the ballooning US government debt that has now reached $32.5 trillion. We have seen a significant drop in foreign ownership of US Treasuries over the last 10 years, which means more and more of the supply needs to find a home from domestic sources. But if the creditworthiness of the US keeps deteriorating, this may be a lot to ask. Now let's switch gears and look ahead to what we see as the probabilistic outcomes for the global economy for the rest of the year. We believe we are at a pivotal moment in the markets where the key fear, inflation, has receded but has not disappeared. Markets are looking forward towards a year of reasonable growth with falling inflation and lower interest rates. Optimism remains intact in most risk markets, and we must question whether we were wrong to be pessimistic about central banks' abilities to bring inflation back to target without triggering a recession. Our first scenario we call muddle through, and we give it a 50% probability. In this regime, the US economy slows but avoids a recession, while Canada slips into a mild recession. Europe begins to grow from near recessionary levels currently, and while inflation uncertainty persists, which constrains central banks from aggressive policy cuts, the magnitude of rate cuts overall is less than 1%. Credit concerns linger in the banking system due to maturity walls, duration bets, commercial real estate exposure, and minimum regional bank profits. We think China will miss its optimistic GDP growth targets as property concerns linger. China also exports moderate disinflationary impulse to the rest of the world. The AI frenzy moderates as productivity gains remain promising but elusive. However, expenditure on AI remains high, keeping tech spending elevated but with little immediate reward. Peak globalization and geopolitical risk dampen speculation globally. Our second scenario we call the new economy, and we give it a 30% probability. Here, AI rapidly makes meaningful contributions to total productivity and becomes widely used across industries. Other technological advancements start to bear fruit, such as robotics, autonomous driving, and energy efficiency. Growth surprises positively based on accelerated productivity, allowing inflation to fall faster than markets anticipate. While wage growth remains robust, unit labor costs stay consistent with the inflation target. Central banks then begin to cut rapidly in the second half of the year. Technology continues to lead the market, while margins and multiples remain at high levels. As a result, equities are still supported by easing policy and liquidity. Optimism around technology improvements and growing economies manage to contain partisan friction and policy extremism. Our final scenario is called the second wave, and we give it a 20% probability. Here, North American economies remain robust in the first half of 2024 as consumers continue to propel the economies forward and households make up for lost consumption during the pandemic. U.S. inflation reaccelerates to over 4% by mid-year due to tight labor markets, loose financial conditions, and expansionary fiscal policies. Central banks abandon rate cuts and consider hikes in a major monetary policy surprise. Europe's low productivity and rising labor costs feed rising inflation in the second half of 2024 as well. China adds large consumption stimulus to monetary easing, and Chinese housing markets rebound. Globally, disinflationary goods price pressures reverse. Fear of trade wars constrain global aggregate supply, exacerbating price pressures. Finally, higher rates and monetary tightening affect real estate, and cracks from the commercial real estate spread to other sectors. So let's put it all together. We believe rates in Canada will be higher for shorter, and we believe the Bank of Canada will cut interest rates at its June meeting while the Federal Reserve will not. There are significant differences in the performance and trajectory of the economies of Canada and the US. In Canada, core inflation is at 2%, growth is at 1%, and unemployment has risen over 1% over the last year, and wage growth is stable near pre-COVID levels. There are multiple reasons to be concerned about interest rates in the US, including the creditworthiness of the country and the supply-demand dynamics of the Treasury market. Finally, we believe that there are 3 paths the global economy could take. Muddle through, which we give a 50% probability, the new economy, which we give 30% probability, and a reacceleration of inflation, which we give a 20% probability. I want to thank you for taking the time to listen to our presentation, and please don't hesitate to reach out to any one of us if you have any questions, comments, or concerns. Thank you so much.